Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I am Billy and I'm joined by my co-host,
Andrew. Bills, we are back again. Got another podcast where the sun is shining for maybe the last time in Melbourne. So we don't have to wear our jackets in the office, but this might be one of the last times we get to do it.
You know, we're in Melbourne and we record about a week before it goes onto the relevant platforms and stuff like that. So people might be listening and watching this and the weather might be really crappy. Yeah. And they're going, what are these guys talking about? So if that's the case, today when we're recording,
exactly why.
It's pretty good, right?
all good in Melbourne for the moment.
That's it. All right, Andrew, without any further ado, what are we talking to our viewers and our listeners about today?
Just talking about a few things actually. So bundling a couple of things all into one today, but kind of what this spurred out of was some client questions around franking credits. That was kind of the starting point. So we'll be talking a little bit about, what are franking credits, how do they work? In addition to that, we'll also be talking about dividends, because that's obviously quite closely related to franking credits. And we'll also be talking about really passive income and how shares can form part of that in your overall portfolio, or in your overall retirement passive income goal. So bundling all of that together into what's hopefully a succinct podcast.
Yeah, and look, also the tax benefits of those as well too. And I guess sort of going on that theme of passive income, in terms of what we do when we're planning for people, one of the things that we do is we look at the environment that we've got available and we try and optimize and maximize opportunities in different environments. You've heard us talk 1,000 times about superannuation and the concessional environment, the rules of preservation. That's just one tool that we use in our kit bag, so to speak. But hopefully this gives some more insight into some of the things that we look at and consider when we're trying to formulate a plan and a strategy to help achieve a client's goals. So Andrew, we might start with a real easy one, passive income. What is it? What are we looking at? What do we think about when we're talking to clients about passive income? Where does that take us?
So look, passive income is essentially income that you're deriving without having to work for it. So you're not putting in you've worked for it because you've contributed to it earlier, but you're not putting in your personal labor in order to be able to generate an income associated with it.
So non-personal exertion, essentially.
Exactly. So can happen in a few different ways, depending on the asset that you're investing in. But for most people, the easiest way to think about passive income is you consider a property, right? Purchase property, capital growth is the value of that property increasing up and down. So you might buy that property for 600,000 and it's worth 650. That's capital growth. Passive income is the rental income that you're receiving from it. That is your passive income. So you're going to receive some form of rent if if it's an investment property, you're renting that property out. So that's the passive income that's associated with it. Specifically, and one of the things that we're focusing on in this podcast is passive income in relation to shares. Shares operate or usually operate in a fairly similar manner in that you purchase a particular stock. The value of that stock is the capital growth. So if you buy for $80 a share and it goes up to $85 a share, you've made some capital growth. The other thing that will also happen in stocks is if the company is making a profit, they'll pay a portion of that in dividends. So dividends is the payout of the profit from that particular stock that they pay out to shareholders.
So I might use a worked example in this one. You own stocks in a supermarket chain, we'll call it Woolworths, right? So Woolworths, I guess most people understand the business model. They get fruit, veg, produce, products. They make them available. People, they buy them at a certain price and they sell them at a certain price and make the money in the middle. There's a few other revenue streams and things like that in terms of them charging their suppliers and things, but we'll keep that separate. But essentially, off the back of that, if you're a shareholder in Woolworths, every time somebody shops, assuming that they make a profit on every item that they sell, depending on how much of the business that you own, there's a small profit associated with that transaction. So you bundle that up over a period of time, over all of the stores within Australia, and there's an amount of money available, or should be an amount of money available for distribution as a profit. The management team will make a decision on what they do with that money. There's really a couple of things that they can do. They can put it back into the business to, upgrade something. They can pay down debt. They can do a whole range of things. But in this instance, we'll talk about making the decision to pay it out to shareholders. And that's what you're talking about in terms of profit. And from that perspective, after you own the share or shares, you will continue to receive that. The level will change, but you'll receive that passively as long as you continue to own that asset. Now, I might just sort of preface this as well too. That's the same theory that we've got across different asset classes. And the theory is that there's a business, there's infrastructure, there's assets that are owned in the assets that you buy, in the shares that you buy, but specifically with Australian shares, we're going to talk about the franking credit system and the advantage that that plays when we think about creating passive income for people.
Yep.
Franking credits. Andrew, what are we looking at?
So really, franking credits are essentially offsetting the tax that the company has already paid. So you consider that same scenario we're talking about, a big supermarket chain, they've made a profit. The company has already paid a tax on that profit.
Yep.
Company tax rate is at 30%. Depending on which environment or where you're sitting, you will get an offset, or you will essentially claim back the tax that the company has already paid, because the ATO should not be double taxing. So let's say Billy Amiridis, as an individual investor, has some money sitting in those Woolworth stocks. Now, his tax rate might be at 37%. So he's already paying 37% tax on any income that he's making. This forms part of his income, the dividend that has come in from that particular stock. If there were no franking credits, and if that was not available, the company would make a profit, so the company would pay their 30% tax.
Yep.
They would then distribute that net money after they've paid the tax to Billy Amiridis, and he will pay 37% tax. So all of a sudden, that money is being double taxed because it's all on the same profit, and it's getting taxed in two people's hands. So what the franking credit is the tax office is recognizing that, hey, Billy, we've already taxed a portion of that money. 30% has already been taken out for the purposes of tax. So on the income that you get off the back end of it, you're not actually going to pay your 37% tax. You're only going to pay 7% tax because we're offsetting that 30% that's already been paid from a company level. Yeah,
so essentially it's a way to prevent people being preventing a double taxation system.
Exactly.
And that's really important when we start to consider passive income, because the taxation element obviously impacts the amount of income that you've got coming through. Now, I won't say most, but a lot of the big name companies in Australia that are listed on the stock market that you do buy shares in do have a franking credit system where they're paying 100% fully franked dividends. Yep. So what that means is that they will pay the tax on the profits that they will receive, and you'll get the benefit of the fully franked dividend in that instance. Whereas there's other businesses that deviate from that. They may partially pay it, or they may not at all.
Yep.
So you need to be mindful that in this instance, depending on which company you're invested in, that what we've described in terms of the franking credit system is not equal across the board. It's up to the company to be able to do it. And I think it really depends on what industry they're in as well too. Depending on what they decide to do with the money, obviously they're managing cash flow, they're managing the operation of the business. If they're capital intensive businesses, like say the mining sector, they may do something different. If they're in a growth phase, they may do something different as well too.
Yep, exactly right. And so there's really a few key takeaways out of that is, number one, not every stock that you're investing in and not every company is going to be a dividend stock. They're not going to pay out dividends, or they're not going to, not that they won't pay out any dividends. I mean, some companies just won't favor paying out profits to shareholders because they're utilizing that money for another purpose. So that's really one of the key takeaways is, if you are looking to build a stock portfolio or invest in stocks, not all stocks are the same, and there isn't a right or a wrong. because they don't pay that money out in dividends, they may reinvest that in their business, and because that's been reinvested and because they're utilizing that to grow their business, the share price is going to grow more. So for some people and for some investors, they're not actually looking for dividend stocks. The other key takeaway of it is not all companies are going to pay 100% fully franked dividends. Yep. So the franking credits associated with it differs from each company for a variety of reasons. They will not always have that, 100% fully franked dividends. Some, it might be 50%, some might be zero. So when you are deciding, where you're going to draw your passive income from, that's going to drastically change the overall scenario, both from a tax perspective and also from a passive income perspective as well.
Yeah. And I think one of the other things to point out is when we're looking at company profits and dividends, the calculation that we tend to look at in the finance world is the dividend yield.
Yeah.
And essentially what that is, and this is a really valid point, maybe not for the point in time that you buy the shares, but when you look at it down the track and in the future, it becomes essentially a phenomenon. Let's use some really simple numbers where a share is worth $100. And based on the historical dividend that they paid last time, they paid out, I'll use really round numbers, they paid out $5 a share.
Yep.
So you divide the $5 into the cost is 5%. So the dividend yield is 5%. It's similar to when you look at a property in terms of the rental yield that you'd get. And that's all good and well. It might cost you $100 to get into that stock. And that's at today's price, because we always look at it like that.
Yep.
And maybe 100 was too big of an amount to use in this instance. But if you consider that company continues to grow, not only in terms of its dividend payout amount, so it goes from an absolute number of $5 and it moves up, let's use an example that the share price goes up as well too. So let's say that the share price doubles in value, and that share is worth, $200.
Yep.
And we'll say that the dividend payout amount goes from $5 per share. Let's say it goes to $20 per share. You haven't done anything different. But if you look at that calculation on your original $100, if you paid $100 for the share and it's paying $20 a share, your dividend payout ratio is now 20, or your dividend yield is 20%.
Yep.
As opposed to if you bought it at $200, it'd be 10%.
Yeah.
So you're getting the benefit of this over time. So that also comes into our thinking when we're talking about, and once again, high quality stocks that you're going to hold for the long term. You'd expect that with businesses, the dividend that they pay out grows over time. The business becomes more valuable, so the share price goes up. But when you start to overlay this and compound this out over a period of time, the numbers can get really significant. And especially if you buy good quality companies for a great price and over a long period of time they go up, the passive income that we can achieve off this, associated with the franking credit taxation benefit that you get, the numbers become pretty phenomenal.
Yeah, exactly right. And then you also look at different tax environments. So, we talk about superannuation fairly often, and superannuation is a lower tax environment. So in terms of the benefit of holding that stock, receiving the dividend, and getting franking credits associated with a lower tax environment, the numbers start to look quite phenomenal when you start to put it all into play. The other benefit, and look, I don't have a proclivity towards one or the other, and I find that some people it's one or the other, but I actually say both. But you consider passive income associated with a particular stock versus passive income that's associated with a property, for instance. You own a particular stock, you're drawing a passive income out of it, you're retired, so that's your only source of income, let's say. In the option of getting that same passive income from a stock, you decide to go on a massive family holiday, and all of a sudden that's going to cost you X amount of money. You need to draw out a portion of capital. You can do so. So it's giving you the option to be able to liquidate a small part of the overall portfolio. If you're receiving a passive income from a property, you're drawing it down, you're getting your regular income, that's sufficient to meet your living expenses. But you want to go on a holiday and draw a portion of that in, or draw a portion of the capital out, you don't have the ability to do so, or it's very difficult to sell the entire property move that into, either another property, which is costly in, stamp duty, or move that into another asset class. It's quite a costly and cumbersome exercise to liquidate all of that property in order to have access to a portion of the capital.
Yeah, so the only way that you could do that in a property really is to downsize. Once again, you hit all of those issues that we were talking about. Potentially borrow money off a future beneficiary.
Yep.
So they will get reimbursed at some future point in time. Or something like a financial product like a reverse mortgage. Yep. But once again, all of these things are complex and convoluted. So from a planning perspective, in terms of the stuff that we look at, one of the things that we take into consideration when we're looking at this is the income requirement needs and having enough flexibility in the strategy and diversifying asset types that are liquid, that can be liquidated. A portion of them can be sold off if something happens. In this instance, it might be a family holiday. It could be things like aged care. You just don't know. But making sure that your strategy, your investment strategy that's supporting you, is robust enough to try and tick a lot of those boxes, and almost trying to anticipate, blowing our own horn here, Andrew, almost trying to anticipate issues that may arise in the future that somebody hasn't even considered.
Yeah, exactly right. And look, what we're looking at when we're building a financial plan, or we're looking at a pool of assets is, what's your short, medium, and long-term assets? What are the short-term assets that if we needed money today, we can draw upon, today if we need it? What are the medium-term assets that, we might not access for another 12 months, a couple of years? And what are the long-term assets whereby, we really want to hold these either for the purposes of beneficiaries, and draw a portion of the income out of it. And when you're considering property, a lot of the times that's a long-term asset. That's an asset that you're holding because you want to pass on to the next generation. You want to draw some income out of it in your, retirement phase, but you don't really have intention to sell it or liquidate it, in the purpose of meeting your lifestyle expenses. And so what are the other assets that we can hold in both this short and medium term that we can draw down if we need? And so that, for that reason, that's why, we're really big proponents of holding assets in multiple asset segments, because you can utilize the benefits of each, asset segment and give yourself more options when the time comes and when you are going to want to draw down on that asset.
Yeah, and we talk about, I guess, diversification in investment markets, and ordinarily you talk about diversification, I guess, from a concept perspective around, the old saying, you don't keep all your eggs in one basket. And, if this asset does this, that asset does this. And the idea is that they complement and support one another. And that's fine from the lens of an investment return perspective. But this goes one step further in terms of you're talking about potential liquidity events in the event that you needed to liquidate a portion of a particular portfolio. And with your harder assets, like as in your physical or your tangible assets, there may be things like the things that you had described where it creates some issues. Obviously, properties, one. Infrastructure assets, just in terms of how long it takes to sell out of them. Property assets like property REITs could be another one. Even things like term deposits as well too. If you needed to break a term deposit early, you can. Some banks need you to give them 30 days notice. The other consideration is that you may forfeit anything that you've earned on that term deposit. So a whole range of thinking around this. And when it comes to diversification, it's not just diversification from an investment return perspective, it's across the type of asset that it is as well too.
Yeah, exactly right. The more assets you hold, the differing assets that you hold, the more options it's ultimately going to give you in the future.
Andrew, I think that was a nice, short, sharp, succinct rundown of sort of our thinking around franking credits, distributions, passive income.
Yeah, absolutely. Hope that that brought some good value to our listeners. Hope that potentially answered a few questions that you might have been thinking of as well. Billy, thank you for jumping on another podcast, and look forward to catching you all in the next one. Make sure to like and subscribe.
And like always, details are in the show notes. We'd love to have a chat, so feel free to reach out, and we'll catch you on the next one.
Thanks very much.
Thanks for listening today. If you have any questions on what we've talked about, or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature, and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd authorized representatives and credit representatives of AMP Financial Planning.